Hey everyone. In this video, I'm going to discuss technical studies that you should utilize or that you can utilize in order to recognize a trend and to take advantage of it. Now, the first thing that's very important to understand is that technical studies by their nature can only tell you things that you could already know. The benefit of a technical study, if there is one, is that it actually communicates information to you that maybe you could figure out on your own, but it would take too much time. In other words, what I want to use technical studies for primarily is to identify something that I could observe myself or I could calculate myself, but it would take me longer to compute that, whereas the study can show it to me quickly, so therefore I can make decisions at a much more efficient fashion. Now, on the chart, I have Meta, the stock META. And what I want to draw your attention to are the lines that are appearing on this chart. Now, the first two lines, this green line and this red line, this green line is showing me the opening price of the session, and the red line is showing me the closing price of the session. Now, this price range I call the YCTO, which stands for yesterday's close, today's open. That was a term that I coined for it to help me to better recognize this price range and also to utilize it. Now, this price range represents the most important price range of the session because it represents the two most important prices, the previous session's close and the current session's open. Now, in this video, I don't have time to go over all the details of why those two prices are so important, but I do go over that in other videos that appear in our education section, as well as repeatedly discussing it in the coaching room. Now, simply what we should understand is that this price range can be displayed on our chart when we go into the settings. So I right-clicked on this chart, I go to settings, and then right here on the left-hand panel, it has two check boxes. One checkbox is to show the line for the previous day's close, the other is to show the line for today's open. I have both of them selected. I have the previous day's close in red and today's open in green. I recommend you use the same colors. That way there's no confusion about what it is you're seeing. Once those boxes are selected and the colors, you click on here, you can select the colors. But once those are selected, then everything is good to go. You could just hit OK. I'm going to hit cancel since it's already set up. Now, what I'd like to look for is a stock that is moving away from this price range very quickly, especially at the earlier part of the session. If a stock is just hovering around this price range all day or trading back and forth through it, generally speaking, that's a stock that's not showing any clear signs that it wants to go anywhere. In other words, it doesn't really look like it wants to go significantly up or down. Obviously, the wider the price range is between these two lines, the more room the stock would have to move. But if the two lines are relatively close to each other and the stock is not getting away from them at either of them, that price range at all, that would basically mean that the stock is not showing any strong indication that it wants to move. Now, having said that, once we've added these on the screen, we can easily detect if a stock is moving sharply away from them. Next, we want to have some sort of tool to measure the degree of variation, the degree of range of movement that the stock is experiencing over a period of time. To do that, I'm using Bollinger Bands. The Bollinger Bands are these bands that you see here. They represent one standard deviation above and one standard deviation below the middle line, which is a weighted moving average in this case. It's very important that you have these settings exactly the way I have to give yourself the best use of this tool for this platform. So to do that, all you would have to do is go up to here, and these will already be on your charts, but nevertheless, in case for some reason they're not, go to Bollinger Bands, hit the plus sign, and then all you have to do is change this to 21 periods, change this to 1, and then I have the color set to this color right here, so that way it's recognizable for me. I'm not going to add this now because I already have it on the screen, but you can see the settings here for your future reference. Now, having said that, the Bollinger Bands, oh, I forgot to mention this, sorry. I forgot to mention that I'm selecting a weighted moving average right here. Okay, that also has to be selected. So I would do, again, one standard deviation, 21 periods, and this. Okay, now I've got everything set. I would hit OK or apply, and then I would have my indicator, my studies on the chart, which are already here. Now, A standard deviation just means how far up and how far down does the stock typically move away from this line in a 21 bar period. So in other words, if you look back from this bar, back 21 bars, or this bar, back 21 bars, this line at that time, the width of the Bollinger Band would represent the degree to which the stock has been moving, including the current bar, the degree to which the stock has been moving up and down around this line over the last 21 periods. Now, that's good because I can't calculate this easily in my head. I can try to guess at what the range of movement is, but that would be fairly inaccurate. So by having the software automatically calculate it for me, it makes it easier for me to know how far away the stock is getting from this average. Now, basically, any good trend should look something where the stock is spending most of its time on one side of the channel. Okay, so if I see a period of time where the stock is spending most of its time on one side of this channel, this may not be considered a trend per se, but it is a move up that was persistent. So therefore, since it kept going, it makes it exploitable, just like this was a move down that was also exploitable. In this case, the stock is mostly staying on the top side of the channel, as you can see here, staying mostly above this purple line and mostly touching the top of the channel. On the other side, it's mostly staying below the channel and sometimes touching the purple line in the middle. The more the stock consistently hangs on the edge of the channel, not getting too far away from it to the top, not moving too far below it, just basically riding the side of it for most of a period of time, the more likely you're going to get a good move that's going to be exploitable. So in other words, the more the stock stays to one edge, the more the trend is likely to play out more in your favor, and therefore you want to look to get into that as early as possible to be able to take advantage of it. Now, this middle line just forms a way of figuring out whether we're trading on one side of the market or the other. So if I'm mostly seeing the stock trade below it, obviously that means that we have more downward pressure, whereas if I see it mostly trading above it, we have the opposite. However, if I see it trading on both sides almost as equally, that means in this period of time, for example, there is no clear trend. There is no clear bias in which direction the stock wants to go at that point. So therefore, this is where I'm likely to get into some trouble if I'm trying to get into a trade during this. I may guess that it's going to go one way and it ends up going the other, or vice versa, right? So it's better to wait till the stock is really on a trend, or at least showing some pattern of movement that seems to be persistent before I get in. Okay. Now, we also have the standard volume weighted average price, the VWAP, VWAP. This is a very well used tool by day traders, but it's mostly coming from the institutional trading background where larger brokerage firms, larger clearing firms, what they would do is use this as a benchmark of how successful they were able to trade during that day. Simply put, if you are selling a stock, you would want your average price of sale to be above the volume weighted average price, whatever it ends up being at the end of the day. If you're a buyer, you want your average buying price to be below the volume weighted average price. If you were able to achieve either of those, you would be considered to have done a good job of executing your trades for that day. Remember that larger scale firms have to do larger scale trades, and therefore they can't do them all at once. So if their average price over a session ends up being below the volume weighted average price, as a buyer that would be good, but if they were selling, that would be bad. Okay, so the VWAP basically gives us an idea of which direction the overall trading is going. The more consistently downwards the VWAP is going and the smoother it's doing that, the more bearish the market is. Whereas if the opposite were true, if the VWAP were going very smoothly upwards, then the more bullish the market is. So it all depends on what's going on that day. But if I see, for example, a stock, that looks like this. Okay, here's BBIB. Not a good price chart, but the volume weighted average price is consistently going up. So even though the stock did not trade in a very reasonable fashion to exploit, the volume weighted average price was consistently going up, which indicated that the price, the volume and price and the effort was mostly to buy the stock on that day. Okay, So just giving you some idea of some of the ways that we could use the VWAP to help us figure out the overall market trend. Now, we should also keep in mind that none of these tools predict the future. They just give us an idea of where things are at. What we have to do is to decide when to get in. Now, personally, I recommend that the best timing to get in, if you're going to use something like this that's very simple, would be to look for a period of time where stock is clearly moving in one direction, then it pauses at some point in that movement, like here, it's going down, then it pauses for a bit and then resumes. On that resumption, in my opinion, that's the best place to look to get in. Now, there are other methods of getting into trades, and they could be just as good, but if you don't have any other method, that's one of the simplest ones to learn. So here's another example where the stock actually pulls up a little bit and then resumes again. That's also a decent opportunity. Whereas if we're going up, you can see over here, the stock's going up, it then neutralizes for a bit and then starts to go up again, basically giving us another opportunity to get into a trade. So in short, these are some of the tools you can use. Now you can use other tools. It's not that these are the only ones, but as I would strongly recommend, make sure that you're not cluttering your chart with all sorts of indicators, thinking that by stacking them on top of each other, you're somehow going to get a better sense of what's going on. Remember that all these studies can do is tell you what's already on the screen. They can summarize it, they can quantify it, but they don't predict the future, and they don't generally tell you anything you don't already know. However, with the right tools, you can get a better, quicker way of analyzing the market and also being able to quantify certain things that would be difficult to quantify, such as the degree to which the stock is moving up or down in a period of time. And those could help you to become more effective in managing your trades. Okay, hopefully that helps, folks. Thanks.